Good morning. Thank you for having me. This is actually my second time at this conference. I have the special honor of having 2 papers on the program this year, so I really appreciate all your feedback, and hopefully you'll see me again in the future. Kandarp was just talking about mortgages. Now I'm going to talk about fintech lending to small businesses. Okay, that's the theme of this paper. This is co-authored with Tetiana Balyuk at Emory and Alan Berger at the University of South Carolina, who you know as the person who contributes in every single session. Okay, all right, so I think some definition in terms is useful. So people throw the word fintech around a lot. Well, what do they mean by fintech? Turns out they could mean all sorts of different things. Okay, so here are all the different ways that finance and technology can be put together. So we have all of these different categories up here. We have markets, insurance, payments, wealth management. All these things are involved in fintech. We're going to be talking about a very specific form of fintech, and that's this dark blue portion at the bottom here, which refers to lending. Okay? And we can see that there's been this increase in fintech lending. And the question that we're going to ask in this paper is what's fueling this fintech lending, and specifically to small businesses? Okay, so the motivation of the paper, kind of the general intuition, is that necessity is the mother of invention. Okay, and to put more generally, we wouldn't have fintech if there wasn't a need for it. Okay, so we're going to focus on small business credit, mainly for the reason that banks are the leading providers of credit to small business, and there aren't a lot of other sources of credit. And we're going to see, the fintech marketplace firms would not have succeeded if banks had been completely successful in alleviating small business financial constraints, offered the most favorable contract terms, and done it in the most timely way possible. Okay, and so I'm going to put a little disclaimer here. That's not necessarily the bank's fault. We've seen a lot of discussion about leveling the playing field, but we're kind of taking the playing field as it is and saying that if all these conditions were met, we probably wouldn't see fintech. Okay, so we're thinking that the obvious place to look for clues on fintech market penetration is weakness in bank credit supply. Okay, so there's been a lot of reduction in bank small business credit, which could provide these opportunities for fintech, and we can see this along 2 different dimensions. The first is that small community banks are disappearing, which is not news to anybody in this room. We had about 8,000 in the year 2000. Now we're up to less than 5,000 in 2019. And at the same time, we saw that big 4 decline in small business, or in mortgage lending. We see the same thing in small business lending. Okay, so the large banks are withdrawing from the small business lending market. It's at 13% lower than the 2007 peak. And we also see that, according to a Fed survey in 2015, that small businesses are more willing to turn to fintech lenders. So about 20% of the surveyed firms in 2015 sought credit from fintech lenders. Okay, so we're going to be looking specifically at marketplace lenders. So we're very specifically not saying peer-to-peer. These used to be peer-to-peer, but now it's institution-to-peer. Okay, so these are online firms that create credit scores derived from machine learning that provide information to investors, which in this case is overwhelmingly institutional investors who fund the loans very quickly using different algorithms. And so we're looking specifically at these marketplace lenders. Okay? I think it's also important when we're thinking about interactions between banks and fintech is to note some of the places where they're similar and where they're different. So one of the main places, one of the main functions that all 3 actors have together is screening. Okay, so fintech lenders, they use transaction-based hard information. They use machine learning. They screen the borrowers. Both community banks and large banks also screen borrowers. They have different technologies for doing so. We think small banks use a lot more soft information. Large banks use hard information and credit scoring. One of the principal differences, though, is the role of monitoring. Okay, we know that banks do not only screening, but also monitoring. And that function is absent for the fintech lenders. Okay, and then finally, funding for fintech loans is provided by investors, where the banks provide the funds themselves. Okay, so it's important to kind of recognize these terms as we think about how these different economic agents interact. Okay, so Chairman McWilliams talked about this yesterday, where you could apply for a mortgage in your pajamas. You could do the same thing for a Prosper loan. So if you log on to Prosper, you can get pre-approved just by filling out some very basic information. Once you get pre-approved, you verify this information with your Social Security number, sometimes with some additional documentation, and then you get a page that looks something like this, where you can select the loan that fits your needs. Okay, so this is a very different process from going to a bank, and as Gandarp was saying, this can happen very quickly. Okay, so the research question that we'll want to ask in this paper is, what is the relative importance of small banks versus large banks in local markets for the emergence of fintech lenders? Okay, so how does local banking market structure affect fintech penetration? And then we're going to go a little bit further and ask, well, what are some of the real economic implications of that? And then, are additional fintech small business loans, are they riskier, are they safer? So why is this important? So maybe this is preaching to the choir, but small businesses we know are important for the U.S. economy. Over 99% of firms in the U.S., 60% of private sector employment, turns out about 2/3 of net new job growth, and produce roughly half of private non-farm GDP. And so this is important, right? Where are small banks or small businesses getting credit? And this interaction between banks and fintech has implications for small business financial constraints. Okay, so why should bank size matter? So I've talked about this a little bit already, but we know that they have different lending technologies. Okay, small banks lend much more to small businesses per dollar of assets, we know that, and they have this comparative advantage in processing soft information, in making relationship loans. They have flatter organizational structures, so fewer layers of management. So we can imagine that if there are fewer small banks around, there's more opportunities for fintech to make some small business loans. But on the other hand, large banks have a similar screening technology to fintech. They use more hard data and credit scoring. So maybe you see when large bank share goes down, that fintech volume goes up. Okay, but we can think that certainly it matters the structure of the local banking market for the emergence of fintech in this market. Okay, so the key variables we're going to look at, we have fintech loan volume, which we'll define as consumer loans to self-employed borrowers, in addition to small business purpose loans. So you can select the purpose of the loan on Prosper. For those that say for small business specifically, we'll include those as well, and this will be in dollars per capita. And then we'll look at the small bank share as our key explanatory variable, which is the proportion of small banks within that local market. Okay, so pictures are always nice to look at this relationship, so I'm going to include a heat map as well. And so you can kind of see, looking at these heat maps, so up top we have the share of small banks, so the darker areas are where you have more small banks in the local market. And on the bottom map, you have fintech loan volume per capita. So again, darker areas where you have more fintech loan volume to small businesses. And you can kind of see, or maybe this is wishful thinking on my part, I can kind of see a negative relationship here where you have more small banks, you have fewer fintech loans, and vice versa to small businesses. Okay, so this kind of gave us some incentive to go a little bit further, do a little bit more analysis, but we can see a pattern emerging from this picture. Okay, so we have three sets of findings. The first is that lower small bank share leads to higher fintech penetration, so higher fintech loan volume to small businesses. And the effect seems to be coming from counties that have better internet access. Okay, with the idea being you can't substitute for a small bank loan with a fintech loan if you don't have access to the fintech loan. So we find that areas that have better internet access is where you see this effect. And then we'll see there's some real economic effects as well. So the fintech loan volume seems to matter for the smallest businesses, those with less than 20 employees, where small bank volume matters for both the smallest and the medium-sized businesses as well. Okay? And importantly, neither matter for large businesses, which is a nice kind of placebo test. We'll also look at some of the risk of the additional fintech loans after small banks exit, and we find that it's lower than that of other fintech small business loans. So kind of the riskiness of the pool of small business loans within that county goes down. Okay? And kind of our broad takeaway is where small banks disappear, fintech lenders are filling part of the void. They're not filling all of the void, but they're filling part of the void, and they're able to reduce investor risk in the process. Okay, just some quick summary statistics. So you can see here we have the number of fintech loans per capita, as well as fintech loan volume. And then we have small bank share, which is, again, the share of branches within a county, is about 60% in our sample. So each observation is a county year. And it's important to note, so the median number and volume of fintech loans is 0 within a county. So a lot of county years have 0 fintech loans. And we keep those because we think there's a lot of information there. And no fintech loans means nobody was seeking fintech loans. but we can also, we have results for dropping these and we get a similar effect. Okay, so to look at some just univariate correlations here, we'll do a similar analysis to the previous paper, and we'll separate small bank share based on quartiles. So here we have the lowest small bank share and the highest small bank share. So you can see in the lowest quartile, average small bank share is about 18%, and in the highest, it's on average close or 98%. Okay? And then we can relate that to the number and the volume of fintech loans, and what you see is as small bank share goes up, the number of fintech loans goes down, as does the volume. And you get kind of this monotonic relationship. And you see that as well no matter how you cut small bank share. You can hold the bank share fixed in 2006, or you can look at the change in bank share. So in those counties where they had a decrease in small bank share from 2006 to 2016, you get higher fintech loan volume than in those counties where you had an increase. Okay, so in kind of these univariate statistics are showing there seems to be a negative relationship between the availability of small banks in a county and fintech loans. Okay, so just to put a bunch of numbers and stars up on the board now, here's our regression analysis. Okay, so again, this is just, again, formalizing the analysis we did, and I just want you to focus on this top number, which is this negative relationship. You have more small banks, you have less fintech loan volume. And you can think about the economic magnitude, where if you have a standard deviation decrease in small bank share, which is about 30%, that's associated with the 7 to almost 8.5% increase in fintech loan volume to small businesses. Okay, so putting this in a regression analysis where we're controlling for a lot of the local economic characteristics, median income, unemployment, house price changes, other characteristics of the banking market, and also kind of these fixed characteristics of counties and across time, we get this negative relationship. Okay, so I'll kind of go over this very briefly. So we're very concerned about being able to identify causation rather than correlation. Alan talked about natural experiments, so we'll talk about how we do that. Is we'll use what we're saying is variation in small bank share that kind of comes from above. Okay, so changes in interstate branching restrictions, how that affects small bank share, and then using that variation to describe changes in fintech loan volume. Okay? Okay, the important thing is a lot of people think that interstate branching deregulation kind of ended in the mid-90s. That was it. We've already done all that we're going to do. We update the index that's used in the literature through 2016, and you can see that there's a lot of change. Okay, we have 39 changes in these interstate branching restrictions in our 10-year period, and the number of states is 30. So you have a lot of changes in interstate branching restrictions, and so we're going to use that to see how that changes small bank branch share. Okay, so you can see these results here. If you have tighter branching restrictions, you're going to have more small banks, higher small bank share, which makes sense. And then using that variation, we again find a negative relationship between small banks and fintech loan volume. Okay. We also, so I mentioned this before, we find that the result is concentrated in areas that have good internet access. Okay, so I know we've heard that millennials like using their phones. It turns out most of these Prosper loans are applied for using a computer, a desktop computer. So this actually hardline internet access matters. And this is where we find the result when people have better internet access. And then looking at some of the real effects that I mentioned before. So here we have employment separated according to the size of the firms. And we can see that fintech loan volume, which is up here, is only related to the smallest group. Small bank volume is also related to kind of these mid-sized businesses as well. Okay? So fintech matters for the smallest, small banks matter for small and mid-size. Okay? We also find, so the fintech loans get safer. Okay? So if you have more small banks, you see that the loss rate of fintech goes up. So to look at it from the opposite side, less small banks means the loss rate goes down. Okay? So the loans seem to get safer. I'll move past this, move past the robustness, and just summarize. Okay? So we see more fintech loan volume where small bank share decreases. We do some statistical analysis to argue that this is a causal relationship. And we can say that some of the increase or the decline of community banks helps to explain part of the fintech revolution in small business lending. And let's just move to the policy implications now. So where small banks disappear, fintech lenders fill part of the void. Okay, not all of the void. That has positive real economic outcomes, but only for the smallest small businesses. And then community banks are still needed for those medium-sized small businesses. Thank you.